Do you need international stocks in your portfolio? That's the question that we're going to answer today. Thanks for joining me. I'm Elliot Abel of Kindness Financial Planning, founder and lead financial planner. And today we're going to talk about international stocks because after the last decade we've had, many people are asking themselves, why not just invest in the S&P 500? Why do I need to own international stocks? Why? I'm going to share up front that the answer is, it depends. But the benefit of this video is that you are going to get to decide for yourself whether you think it is worthwhile to own international stocks, given the history and the data that I'm going to share here in a moment. So first, let's answer, what are international stocks? There are three categories that make up international stocks. 1, developed markets, 2, emerging markets, and 3, frontier markets, which are lesser known, but I'm going to include them in this video because you'll likely come across them at some point in your research. Let's talk about what international stocks, or specifically what developed international stocks are. Developed international stocks are places in countries like Western Europe, Japan, Canada, Australia. They tend to have more stable political economies, or at least in the past I could say they had more stable political economies. I'm not sure if that's the case anymore, but they have better property rights, better laws protecting people, just everything is a little more established, right? Developed international, developed is right there in the title. Next, let's look at emerging markets. Those are places that have, say, less mature economies, less political stability, less secure property rights. They're developing all of the laws that a lot of developed nations already have. To give you an idea of the types of countries, those are China, Taiwan, India, South Korea, Brazil. And I mentioned South Korea, but depending on the provider, and there's different providers out there that categorize indices, South Korea might be on emerging markets or it might be on developed international. It depends on the person or the company that is providing that index list and how they look at specific countries. Some get upgraded from emerging to developed, while others will keep them on their emerging market list. And then finally, you have frontier markets, and frontier markets are the status before emerging. So you go frontier, emerging, developed, international, and frontier markets you can think of as even less stable politically, less secure property rights. All the things that mature economies have, they don't quite have yet, and they're developing. A few countries that are frontier are Vietnam, Bangladesh, Morocco, the Philippines, places that have economies and they're there, but they don't make up a large portion of the world or strong property rights that you have in other countries. So let's get to the question of international stocks. So when I talk about international stocks, I am talking about developed international, emerging markets, and frontier markets. So do you need them? And again, the answer comes back to it depends. The first major benefit of international stocks is you get a diversification benefit. They tend to zig when other economies zag. So if US markets are doing well, sometimes international stocks are doing poorly and vice versa. And unfortunately or fortunately, depending on your portfolio, over the last decade plus, US stocks have done really well. So this leaves a lot of investors asking, do I even need international stocks given everything that has happened? But if we go back in time, we can see this hasn't been always been the case. There tends to be cycles where international will do better, and then US markets will do better, and then it will reverse. And so we can look at this chart here and see that between 2000 and 2009, international stocks did fairly well, while the US market actually had negative returns for a decade. Get that. Negative returns for a decade. Can you imagine if you were an investor and you had negative returns for a decade? What are the odds that you hold on during that time period? If you're like most people, probably not very high. But you'll see that over this last decade, from 2010 to the end of the decade here, we've had really strong returns in US markets, and international markets have struggled a lot, which is why a lot of investors are raising this question. But we want diversification in our portfolio. We don't want everything behaving the same way, particularly if you're going into retirement, because you have sequence of return risk, where if everything does poorly at the beginning part of your retirement, that may shift how much you can spend from the portfolio or what sort of risk you need to take in the portfolio. Another benefit of investing in international stocks is that you get to participate in global growth. If you look at the total market capitalization of the world, so if you look at all stocks and what they make up, US stocks are about 60% of the market, and international stocks are about 40%. So if you own 100% US stocks, you're essentially saying, I don't want exposure to the other 40% of the world. I don't want to participate in their bright minds and their business ideas and their work ethic, anything having to do with those companies, countries, or people there. And to me, it's a big problem because there's great ideas from outside the US, there's great business ventures, and I personally want to participate in the growth across the world, not just in the US. I don't think there's a monopoly on good ideas for businesses within the US. Sure, there are risks with developing international stocks, emerging markets, frontier markets, and we'll talk about those in a bit, but the benefit to me is that you get to participate in all these great ideas from across the world. So what are the disadvantages of international stocks? One, currency risk. And this is a big one. If the dollar is doing very strongly, international stocks can suffer because anytime you have a strong dollar, that means that the international stocks are declining in value, all else being equal. So you could have a really strong performance in international stocks, but if the dollar appreciates quite a bit, you may see little to no return, or even potentially negative return on your international stocks if the US dollar is appreciating. It also goes vice versa, that if the US dollar is depreciating against another basket of currencies, then in that case, international stocks could even have stronger performance. Because when you're investing in international stocks, you're investing in that local currency. So you are subject to currency risk and the currency fluctuations that go along with it. Now, in the short term, this can be really pronounced. If the dollar appreciates, say, 15% a year, you'll see that in your returns and you'll feel that in international stocks. But over time, there isn't an expected return in currency, so this tends to wash out over longer periods, which is most people's time frame. And so longer term, it doesn't make sense to hedge your currency and just accept the short-term fluctuations. Another risk investing in international stocks is the geopolitical risk. And we know this really well because of what's happening in Russia right now. Russia did make up part of the stock market universe and part of international stocks. And when they stopped trading and people or index providers started removing them from indices, you essentially saw a lot of values go to zero. Now, Russia didn't make up a ton of international stocks, but they were a portion of that. And for those that had heavier exposure to that, they did suffer some losses. So we always face the risks within terrorism or wars or anything else that when we're investing in international stocks, we have that geopolitical risk. A few other risks here is that we have less information and there's also less liquidity. There's fewer analysts typically covering international stocks than, say, a stock within the S&P 500 that receives probably far too much coverage than it actually needs, and less liquidity. Shares trade on a daily basis within the US quite a bit, particularly for larger US companies. If you have an international stock, it may not trade as many shares per day, or it may not trade in a single day, depending on how small of a company it is and which country it's located in. So you have that risk that you may not be able to exit a specific stock, or the index isn't able to exit that in those situations. And finally, not necessarily a risk, but maybe a disadvantage, is that you do have to deal with foreign tax credits. So if you are investing inside of a brokerage account, there are foreign taxes that are withheld on dividends, but you do get that tax credit back within the US, so you're essentially not getting double taxed most of the time, which just means one more tax form, or one more line item, I should say, on your 1099. It's not a big deal, but it is something to be aware of. The next common question here is how much should be invested in international stocks? And again, it goes back to it depends on what risk you're willing to accept. Most people will say somewhere between 20 and 60% of your stock portfolio should be in international stocks. I tend to just go with the global market capitalization, which is about 40% stocks right now, because I want more or less that world weighting. I don't want to deviate significantly from that. If I do, and let's say I own more US stocks, I have what's called a home country bias, which isn't necessarily a bad thing. It's benefited people over the last decade. But if you're investing more in your home country and it does poorly for an extended period of time, you may wish you owned other stocks outside of your own home country. And that's happened to other countries in the past, US included, Japan, a few others that saw really long periods of poor returns. And finally, how should you get international stock exposure? It's really up to you. My personal philosophy here is that exchange traded funds or mutual funds that are broadly diversified, low cost, and tax efficient are the best way to access this market, because you can go out and you can own an emerging market fund or a developed international stock fund that's going to own thousands of different stocks from around the world, which is really helpful to get that low cost exposure. You can go out there and you can trade stocks on their actual exchange. So you could open a certain account that allows international trading, but that introduces new complexities and challenges and costs that I personally don't want to deal with, and I think a lot of people probably don't want to deal with either. The other option is American Depository Receipts, or ADRs for short. You can invest in ADRs. It's a way to get exposure on a US exchange and trade on a US exchange while still being an international corporation, but they do come with some risks and they trade a little bit differently and maybe a little less frequently. So my personal preference is to do it through exchange trade funds or mutual funds, own thousands of stocks in one fund. Makes it really easy and low cost. Even though international stocks have struggled over the past decade, I still think it's a prudent decision to own them in a portfolio, but really, it's up to you. You need to decide what's best for you and what sort of risk that you're comfortable with. Some people are not as comfortable investing in international stocks, and that's something to be aware of. If you have the wrong portfolio you can't stick with through good and bad times, then it's probably the wrong portfolio for you. But hopefully this helps provide some context on whether international stocks make sense in your portfolio. Thanks for watching. Hopefully you learned something new, and if you enjoyed this content and want more of it, hit that like button and subscribe to this channel to receive more educational videos like this one. Thanks for watching.